Hello investors and traders. This video will explain the basics of the MACD indicator and how you combine this technical indicator with three other indicators to have a strategy in investing. The moving average convergence divergence is a trend following momentum indicator showing the relationship between two moving averages. To successfully use MACD, you must know the definition, parameters, and key takeaways to effectively use this technical indicator. All right, let's get ready to learn about MACD. Before you start using the MACD as an indicator, you should know the basics of this indicator. What is the MACD? MACD is short for Moving Average Convergence Divergence. It is a trading indicator used in technical analysis of stock prices created by Gerald Appeal in the late 1970s. MACD is designed to reveal the changes in the strength, direction, momentum, and the duration of a trend in a stock's price. The MACD indicator or oscillator is a collection of three time series calculated from historical price data, most often the closing price. These three series are: number one, the MACD series proper. The MACD series is the difference between a fast, short period, exponential moving average, EMA, and a slow, longer period, EMA of the price series. 2. The signal or average series. The average series is an EMA of the MACD series itself. 3. Divergence series. Divergence series is the difference between the MACD series proper and the average series. The MACD indicator thus depends on three time parameters, namely the time constants of three EMAs. The notation MACD ABC usually denotes the indicator where the MACD series is the difference of the EMAs with characteristic times A and B, and the average series is an EMA of the MACD series with characteristics times C. These parameters are usually measured in days. The most commonly used values are 12, 26, and 9 days. That is MACD 12, 26, 9. As true with most of the technical indicators, MACD also finds its period settings from the old days when technical analysis used to be mainly based on the daily charts. The reason was the lack of the modern trading platforms which show the changing prices every moment. As the working week used to be 6 days, the period settings of 12, 26, 9 represent 2 weeks, 1 month, and 1.5 week. Now, when the trading weeks have only 5 days, possibilities of changing the period setting cannot be overruled. However, it is always better not to use MACD alone, but combine this indicator with other indicators. Also, finding the right parameters could show better results, as everyone knows the 12, 26, 9 values. Traders use the MACD for determining trend direction and potential reversals. It is used to confirm trades based on other strategies, but also provides its own trade signals. Two lines compose the MACD: the MACD line and the signal line. These lines move together, except the MACD moves faster, as the signal line is a moving average of the MACD line. The MACD histogram that oscillates above and below zero shows the extent to which the MACD line is above or below signal line. The histogram provides a short-term view on recent momentum and direction. A fast EMA responds more quickly than a slow EMA to recent changes in a stock's price. By comparing EMAs of different periods, the MACD series can indicate changes in the trend of a stock. It is claimed that the divergence series can reveal subtle shifts in the stock's trend. Since the MACD is based on moving average, it is a slow indicator, lagging indicator. As a future metric of price changes, the MACD is less useful for stocks that are not trending, trading in a range, or are trading with unpredictable price actions. Hence, the trends will already be completed or almost done by the time the MACD shows the trend. Takeaways. Number one, moving average convergence divergence, MACD, is calculated by subtracting the 26 period exponential moving average, EMA, from the 12 period EMA. Changing the values might bring better results. Number two, MACD triggers technical signals when it crosses above to buy or below to sell its signal line. Number three, the speed of the crossovers is also taken as a signal of a market is overbought or oversold. Number four, MACD helps investors understand whether the bullish or bearish movements in the price is strengthening or weakening. Number five, MACD is a lagging indicator and should not be used alone. Combining the MACD with other indicators could bring better results with stop losses. MACD is a popular indicator in technical analysis which has stood the test of time. It is easy to understand and to apply to any market or any time frame. Now we learned about the MACD, but the real question is, how do we use the MACD indicator to profit in the stock market? As the market moves around, the MACD line will oscillate with ups and downs of the market. Then we have a second line that gets plotted, which is the moving average, to smooth out that line and give us some signals. The crossover would be a buy or sell signals. You are looking for a crossing point of the MACD with its actual trigger line. When the MACD crosses down below its trigger line, that is considered to point where the indicator is considered overbought and could possibly indicate a short position, or you could sell your current position. Vice versa, if the indicator crosses above its trigger line, this is a point where it could be a turning point to the upside where you could possibly buy and go long. As you see, MACD buy signals and MACD sell signals. A lot of traders only use the MACD for reversals, and especially for major reversals, again coupled with 3 to 4 indicators. I have seen the MACD alone has not given good results. The MACD coupled with other indicators gives good results. Most individual indicators, including the MACD on its own, is just not enough for effective trading. But it is part of an overall set of tools and a process. Some examples of combinations are MACD with RSI, Relative Strength Index, CCI, Commodity Channel Index, and ADX, Average Directional Index, even combining 4 indicators to give you a clear picture of what's going on. MACD is a popular indicator in technical analysis which has stood the test of time. It is easy to understand and to apply to any market or any time frame. This tool measures a stock momentum and can aid investors in spotting changes in market sentiment. Some key points. Number one, MACD is more of an oscillator identifying key turning points. Number 2, excellent jobs at high points and lower points. Number 3, does not do a good job in a narrow range. Combining with other indicators to combine with the MACD, for example, a crossing of the MACD with RSI below 30. This will give you an entry and an exit. Future growth will be based on other indicators. There are many interpretations of how to use the MACD. Many systems and software programs are based on some tweaks to the MACD. MACD can spot trend reversals by looking for a divergence of momentum. Learning to implement and recognize MACD signals will assist you in your investment plan. If you find this video helpful, please follow Insight of Investing. The next videos of interest could be other indicators or further in-depth analysis of the MACD. Good luck on your journey. Study it, analyze it, adapt it. Peace.